You know, everyone in finance is always asking the same question. What really separates a good investor from a truly great one? We're all searching for that secret sauce. Well, today we're going to dig into that. We're going to explore a few key archetypes of success to see if we can find the common threads that tie all the legends together. Let's get into it. So, what is it? Is there some magic formula? A perfectly designed system that you can just plug and play? Or is it something a little deeper? Something more about temperament, about philosophy? We're going to look at two very different archetypes, the architect and the engineer, to see what they can teach us.
And our journey has to start with the architect himself, Benjamin Graham. I mean, this is the guy they call the father of value investing. His ideas are literally the foundation that so much of modern finance is built on.
His book, The Intelligent Investor, is nothing short of legendary. And think about this. Warren Buffett, probably the most famous investor of all time, said it's by far the best book on investing ever written. That is a massive endorsement. So yeah, the principles in this book, that's our starting point. The absolute cornerstone of Graham's entire philosophy is this idea he called the margin of safety. And the concept is beautifully simple. You buy a stock for way less than you think it's actually worth. That gap, that discount, creates a buffer. It's your margin for error, protecting you if you're wrong or if you just get unlucky. It's really the bedrock of smart defensive investing. Now, to explain how to actually use this idea, Graham came up with one of the most brilliant metaphors in all of finance. He asks you to imagine you're in business with a partner, a very, let's call him a moody partner, named Mr. Market. See, Mr. Market isn't rational at all. He's a total basket case of emotions. Some days, he's just bursting with euphoria, and he'll offer to buy your shares for way, way more than they're worth. But on other days, he's totally paralyzed with fear and will offer to sell you his shares for practically nothing. And here's the whole lesson. You don't listen to Mr. Market. You don't let his crazy moods affect your own. No, the intelligent investor sees his emotional roller coaster for what it is, a giant opportunity. You sell to him when he's giddy, and you buy from him when he's terrified. You treat the market as your servant, never your master. All right, so now let's switch gears to our second archetype, the engineer, Ray Dalio. If Graham was the architect who laid the philosophical groundwork, Dalio is the engineer who is absolutely obsessed with building a repeatable system, a machine, really, for success. For Dalio, everything, and I mean everything, starts with this one simple but incredibly powerful question. Is it true? His whole worldview is built on this idea of radical truth and transparency. It's all about stripping away your ego and all your wishful thinking to see reality for exactly what it is. And Dalio turns this hunt for truth into a very concrete 5-step process that you can use for pretty much anything. First, you set clear goals. Easy enough. Then you're going to hit problems. That's inevitable. Now here's the crucial part. You have to diagnose those problems to find the real root cause, not just the symptoms. Once you've done that, you design a plan, and then you just execute. It's not a one-and-done thing. It's this relentless loop of improving and evolving. And this all comes together in his big metaphor of the machine. He sees an organization, or even just your personal life, as a machine. It's got inputs, your goals, and through its design and the people involved, it produces outcomes. And if you don't like the outcomes, you don't just complain about it. You debug the machine. You figure out if the design is wrong or if the people are a bad fit. It's a pure engineering approach to getting better. Okay, so we've got the architect's philosophy and the engineer's system, but, today's investing world is a whole different beast. It's complex, and it raises some pretty serious questions about whether those old principles are even enough anymore. In fact, there's a huge debate raging online right now about what really drives success today. Is it skill, or is it something else? Let's take a look. This whole debate often gets fueled by data points just like this one. You've got online groups that track the publicly disclosed investments of political figures. And, well, some of the returns they post are just jaw-dropping. When you see numbers like this, you can't help but ask, how is that even possible? A big focus of this online debate centers on the investment success of Nancy Pelosi. And if you look at the discussions, you see two very different stories emerge. On one side, people argue it's all about skill and experience. They'll point out that her husband is a very experienced trader with a long history, and hey, their trades are public record. But the other side is incredibly skeptical. They suggest this success comes from privileged access to information that the rest of us just don't have, and that it's all about her position, not her investing skills.
And here's a pretty blunt quote from one of those discussions that really sums up that first argument. This user basically frames it as a matter of public information and long-term experience, and even suggests that anyone who doesn't see that is just lazy. And then, for a completely different flavor, you get this sarcastic take. This user implies the secret isn't skill at all, but some one simple trick, which is a clear jab at the accusation of using an unfair advantage that comes with a high-level political position. It really shows you just how divided this whole conversation is. So, where does that leave us? We have these timeless, foundational principles. We have these super systematic approaches. And then we have this messy, modern debate that kind of calls all of it into question. So how do we sort through all this? Well, let's try to cut through the noise and find those common threads that seem to define great investors no matter what era they're in. You know, when you boil it all down, the true legends all seem to share these core traits. They have a philosophy, and they actually stick to it with discipline. They do their homework, they keep their cool when Mr. Market is freaking out, they're thinking in years and decades, not minutes and hours, and they always manage their risk, whether that's with a margin of safety or some other method. So what's the big takeaway here? I think it's that there is no single secret formula. The real secret might just be that the greatest investors find a system, a philosophy that perfectly matches their own personality and temperament, and then they apply it with just unwavering, unshakable discipline through all the market's ups and downs. Which leaves us with one final big question to chew on. You know, Graham wrote about being an intelligent investor almost 75 years ago. In today's world of high-speed algorithms, meme stocks, and instant access to everything, what does that idea even mean anymore? What are the traits that are going to define the next generation of great investors? That's definitely something to think about.